We are very excited to have Pete Stavros join us. And I think I first met Pete, gosh, it's probably been years, but you did a presentation at the Rutgers Fellowship on some of the work KKR was doing then. And so this work that he's doing, it has popular news media right now because of course it's a big brand like Harley Davidson and there's that. But this work that he's been doing is been there for years, and he's been a supporter of employee ownership, and his work, in presentations with the Rutgers Fellowship has always been much appreciated. So I'm going to read his bio for you. So Pete joined KKR in 2005 and is co-head of America's Private Equity, a member of the investment committee within KKR's America's Private Equity platform, a member of the Healthcare Strategic Growth Investment Committee, and is co-chair of the firm's Global Inclusion and Diversity Council. He has led a number of highly successful investments at KKR, including HCA Healthcare, Ingersoll Rand, Capsigal, Capital Safety, and CHI Overhead Doors. Prior to becoming co-head of America's Private Equity, Mr. Stavros, Pete, led the industrials investment team, where he pioneered an innovative employee engagement and ownership model. This approach has been successfully implemented at a number of companies and has positively impacted over 25,000 lower income employees. He has also helped non-KKR companies such as Harley Davidson implement this model. Mr. Stavros and his wife are in the process of launching the Center for Shared Ownership, a nonprofit aimed at driving greater financial inclusion in the economy. Prior to joining KKR, Pete was an investor with GTCR Golder Ronner. Did I say that right?
Yep.
Where he was involved in the execution of numerous investments in the healthcare sector. He holds a BS in chemistry, magna cum laude from Duke University, and an MBA with high distinction, Baker Scholar from Harvard Business School. So welcome, Pete, and thank you for sharing some of your time with us. Much appreciated.
No problem. Thanks for having me.
So we are going to kind of let you run the show here. Thanks to the commissioners who pre-submitted some of your questions, and feel free to take it away.
Okay. Do you want me to, I'll give you a little bit of background, and then I can run through some of these questions. Definitely interrupt me along the way. If there's anything you want me to talk more or less about, you can speed me along if I'm touching on things that aren't of interest or you guys already know. This started, well, to go way back, this started with my dad. So my dad was a construction worker in Chicago and earned an hourly wage. He was a member of a union. And I grew up, living through lots of conflict between the workers and the company. And my dad was very careful to make sure my sister and I understood the plight of a low-income worker and what it's like to earn an hourly wage, where your employer is always trying to, reduce your hours and you're trying to get more hours. And the lack of incentive alignment was something that always troubled him. And he always wanted really some kind of profit sharing in the union that he was in. So that's kind of where it started. And then when I became an investor almost 25 years ago, one of the first things I worked on was an ESOP. This was called Gleason Corporation. And that really grabbed my imagination. And I had an opportunity at business school to study ESOPs in great depth. And I met Corey Rosen, who was a great friend to me way back then, helping me write this big thesis on private equity and ESOPs. And that's where I got to know Joseph Blasi, and a lot of the same lovely characters are still around the scene today. And then when I got into a leadership role at KKR, I had a chance to experiment with non-ESOP, non-co-op forms of ownership, because, big public companies and some of these bigger private companies that don't lend themselves as well to ESOPs and co-ops. And I do think there's a number of things that, and I've spoken with some senators about this, would be great to change about the ESOP legislation. I think would make them more applicable today, which we can talk about if you're interested in. So that's a little bit of the personal background. And then at KKR, where this started was we made an investment in a company basically where the level of engagement of the employee base was very low, and it was impacting performance. It was impacting their own quality of life and their happiness on the job. And so that's where I started experimenting with this model, starting with ownership and then building on these foundational components of engagement over time. So maybe just to jump into some of the questions, and again, please stop me along the way. So one of the questions was, what are the compelling drivers that resonate with sellers? So the truth of the matter is there are not a lot of situations where sellers place a huge amount of importance on the fact that if we acquire a company, we're going to make all employees owners in the business. You generally still have to have the highest price in an auction, particularly for companies of the size that we are looking at. Having said that, I'd say any tie goes to us when we're going to roll out this model. And if it's close, the sellers will usually defer to management, and the management team will often, be very vocal that they would want to roll out this kind of a model. But you got to be close. You can't be, way off the mark on value. Anything else on that question before I move on?
Yeah, Pete, can you talk a little bit about the scale and sectors that you're active in?
So we are active as a firm in the United States across industrials, financial institutions, consumer, not so much retail anymore. We don't really do energy anymore. TMT, which we really separate into media, information services, and data analytics, and software, and healthcare. Those would be the main sectors that we're active in. We've really, incubated this employee ownership and engagement model in industrials. There's lots of reasons, as I often say publicly, about industrial companies that lend themselves really well to this, because you've got the vast majority of your employee base earning an hourly wage who are critical to your success, but they're often pretty darn unhappy in their jobs and they're not well paid. But we are experimenting with this more broadly. And certainly my partners in the US are supportive of, seeing where this can be applicable beyond just industrials.
I appreciated your comments on value too, because this is, as you know, one of the places in particular with ESOPs, the idea of adequate consideration seems to be a pretty big point of, litigation, not even necessarily DOL audits, but, what is fair purchase price and what does that mean? And I think that's my theory is that's one of the things that steers people away from ESOPs, is it just, it's a scary idea of what actually is fair. And we know valuation firms do a wonderful job at trying to figure that out. But depending on what market you're considering selling into, that can have quite a bit, if you're selling to a strategic versus selling to a PE versus selling to whatever, that can change what adequate consideration looks like. So I know this is an evaluation discussion. I think it's a really interesting point that you made.
I definitely agree. And I've pitched many ESOP conversions. One of the things that we are lacking today are ESOP conversions at scale. Most of what we're seeing are very small companies. And every time I pitch it, the seller's interested, the family's interested. There's huge tax advantages, as you guys know, in terms of a family selling to their employees. And then, of course, the go forward benefit to the company from a tax perspective. Typically, when their lawyers get involved, they say, oh my goodness, I've studied this. I understand the risk to you. Why would you do this? It's not worth it. So that has been an impediment. If we were just to touch on the earlier topic of if we were to write this all from scratch, I think this would be better situated under the SEC than Department of Labor. I wish it weren't an ERISA plan. I think a lot of the employees in ESOPs, many are trying to make ends meet and would like access to some of that capital, not just at retirement, but earlier on. And I think sellers would feel more comfortable if a financial part of the government, like the SEC, were in control. Not that the Department of Labor is not super capable, but this is not really their bread and butter, so to speak. And then the other things I would change would be, I think that the trustee setup could be a little bit more easy to work with. The governance structure can scare people away. I think the complexity of setting the ESOP up and the time it takes makes it harder for employees to be competitive in an auction. process. I think the redemption obligations, I see an alarming number of ESOPs de-ESOPing, often under the weight of the redemption obligations. I think if we could go way back in time, it'd be great if you could get the full tax benefits without sharing 100% of the common equity with employees. It's very expensive. The law was set up when companies were trading for a slight premium to working capital. Maybe the whole company was trading for 6 times cash flow, and you could borrow 5.5 or 5 3/4 times cash flow. So what the employees needed to come up with was a sliver of equity. Today, any halfway decent company trades for 12 times cash flow, and the leverage levels haven't really changed. So just the amount of money the employees have to come up with to buy a company of scale and a high quality business, I think, is daunting. So the law in some respects was set up for a different time in terms of the valuation markets and how the capital markets work today.
Well, maybe that's a good way to segue into the other questions of, this in-between option, as we call it. Has that informed how you structure some of these other non-ESOP deals, and your thoughts on that?
Yes. So we have not done any ESOPs. As I mentioned, I've pitched a bunch of conversions, but I don't want the fact that we can't convince sellers to do it or that can't make the math work to stop us from sharing ownership broadly. So really what we've done is in a non-ESOP environment. So we lose the tax advantage, but we gain the benefits of, it's not an ERISA plan benefit. It's not, it doesn't have a lot of the transactional complexities, doesn't have the redemption requirements. It's simpler to implement. We can be very efficient in setting this up. It doesn't slow us down in competing with in a process. And basically we just are sharing ownership broadly. It's that simple. 100% of the employees participate in ownership. We've done that many different ways in terms of everyone's getting allocated actual restricted stock, to everyone's getting options, to we have, in very large populations, we'll sometimes have pools of options that people are participating in, to not create an undue amount of administrative complexity. So we've done it many different ways. And then, of course, it's not just about ownership. If you're going to build culture and make the employees' experience better and make the company stronger, it's got to include all of the other components in terms of the company, welcoming in, at least to some extent, the worker's voice in the business and sharing information and data, the business plan, the value creation program, how they're doing every day, every week, every month on the value creation program, making investments. And we do a lot of personal financial literacy training. We work with Operation Hope on that. So, it's got to be more than just ownership if you're going to try and build culture, because ownership is primarily, but not exclusively, about money. It's first about, it's a compensation discussion. And if that's the extent of the discussion, then it's just really about money and not about how you engage with, your colleagues in a different way.
Do you want to just pick your way through some of those questions?
Yes, absolutely. Okay. Let's see, in terms of industries around employee ownership, my thinking on this is evolving. What I used to say in interviews is I would say, well, this is great in industrials, but take a retailer, for example. I was always the example I would give. The employee turnover is too high, too many employees, it's never gonna work. There's so many employees, you can't give a meaningful amount of ownership, and the turnover is so high that if you start talking about a 5-year business plan, you've lost most of the colleagues in the first 10 minutes. My partner, who co-heads private equity with me, is pushing my thinking on this in a very good way. And his question is, okay, well, let's say you take a company like a retailer. Sure, it's got a lot of employees. Sure, there's a lot of turnover. But what if you move that turnover from 100% a year to 80%? And what's the cumulative impact of that over 5 years? Think of the benefits in terms of how much less hiring you're doing, how more consistent the employee base is. It's still got high turnover, but even that incremental benefit could be absolutely transformational to that company. So I think you are going to see us experiment with this more broadly. And people like my partner, Nate, are opening up my thinking to using this more broadly. And we're experimenting with it, as I mentioned. Let's see, what in your experience motivates LPs and investors to buy in to support employee ownership? I think it's the two options: to improve employees' well-being and their financial security, and then also to try and get performance out of the company. I think as investors, we need to be careful how we talk about it, because what we don't want to be doing is in an era where we are all trying to get out of the shareholder primacy mindset, where it's all about the shareholders. I think we don't want to be trying to orchestrate something where if you give low-income workers a little bit of ownership, well, then we can get even more performance, so we can make even more money as shareholders. I think it's got to start with, this is the right thing to do. It's equitable. Everyone should participate in the profits of a company and the value creation over the duration of an investment. It also then happens to be good business. It also happens to be the case that you will have improved employee retention, higher levels of engagement, lower absenteeism, better health outcomes, et cetera, which happens to be good for the company. So that's how I think about that. Cooperatives are interesting. I am not an expert at all. I've spent some time with nonprofits who do work with cooperatives. I've spent a fair bit of time with a group called Project Equity, which is doing very interesting work, and I'm trying to learn from, particularly around worker voice. So they are, if you can imagine, the extreme is a co-op where the workers run the business. A traditional corporation would be on the other extreme, where there's really almost no input taken from the workforce. And so we're trying to learn from a cooperative on how do you do that? How do you incorporate input without confusing, in some cases where decision-making rights need to reside for the good of the company. But there's a lot around worker voice that, frankly, I don't think we're that great at. We're working on it, and we're trying to learn from cooperatives. How do you classify the Harley example of employee ownership? We are calling these models in between. I think that sounds good to me. Is there a better label or category to help interested companies connect with the idea? I see the Harley deal misclassified as an ESOP. This is a bit confusing to people. I totally agree with you. One of the key differences is, aside from the senior management team, employees don't purchase equity with us. So when we do this, it's a free benefit. It's like on top of your health insurance. And so one of the other challenges with an ESOP is, as we all know, whether it's United Airlines or Tribune, some of the examples where it didn't work out, the risk is people lose their jobs and they lose their retirement savings. And here, this is a free benefit. So it is different. I like your example of in between. We don't get the tax benefits of an ESOP. But aside from that, I think we're able to garner all the other benefits in terms of culture and building wealth for employees. Now, we don't build, I'd say, as much. I mean, some of these ESOPs, as people know, you can have low-income employees generate $1 million of wealth. We're not quite at that level. We've definitely had plenty of six-figure examples, but not at that level. We don't have the tax benefit, which obviously in large part accrues to the benefit of the employees in an ESOP. Do you see philanthropy playing a role in advancing employee ownership? As you mentioned at the outset, my wife and I are starting a nonprofit right now. It'll officially launch in the summer. I think we'll start with about $20 million funding, so it's going to be a real effort. And we've got some blue chip base of supporters, including groups like Ford Foundation. And I think the role that we are trying to play is to advance this in between model. We're not doing ESOPs, we're not doing co-ops, but that doesn't mean if you don't qualify for one of those two models that you shouldn't do this or you can't do it. I think there's a way to do it really effectively. And so we want to help companies who want to try this in between model. We're working with private companies, family-owned businesses. There's some public companies exploring this, and we're trying to help from a hands-on practical perspective. How do you do this? Tax implications, accounting implications. How do you structure it? How does vesting work? What retention requirements do you put on the stock? And then there's the whole second part of how do you use this to build culture? So that's one thing. We are trying to, I'll borrow from Project Equity. They talk about normalizing employee ownership, which I think is kind of a cool idea. So I think this will be announced tomorrow in the Wall Street Journal. We're gonna, the Center for Shared Ownership is going to put over $1 million against a documentary film, which is basically going to follow a company on this journey of transitioning into employee ownership, follow the lives of employees over, a number of years, the management team, et cetera. And there's the great moments where there's payouts, and certainly at the end when the company goes public or is sold, those are great moments. But there's also everything along the way on how does the CEO and the management team, how do they share information in the business plan, and how do they handle some of the difficult conversations of an employee saying, hey, I'm an owner, I have a voice, and I want a voice in issue XYZ, where the CEO doesn't agree. How is that conversation handled? How does an employee who's an owner who makes, $15 or $20 an hour, and the company's, making millions, is that fair? Or how is that discussion handled by the CEO? Because if you do this, you are opening up the books, you are showing people the profits of the company and the growth of the company, et cetera. So we're trying to capture all of that in the film as well. And that's going to be, the film's going to be made by a guy called Nathan Havey, who did a great film, if you haven't seen it, called Beyond Zero. He's an excellent filmmaker. So moving on here, do you see the potential for a new model for employee ownership, hybrids for equality, synthetic equity, ESOP co-op? I don't know. We kind of have a in-between model, as you guys said earlier. There may be other ways to do this. That's one of the things that this nonprofit is going to do, is going to work with academics, work with some research institutions, and basically run experiments on what if we do it this way? What if we do it that way? Can we get more engagement? Can it be better for employees? Can it be better for the company? So that's part of what we're going to be doing, as well as running a bunch of experiments around employee ownership. I understand the KKR does not have a financial stake in Harley Davidson. How many companies within the portfolio has this been implemented? I think it's about 10. Have you seen meaningful increases? Yeah, what we see, the question is, have you seen meaningful increases in profits, productivity, and retention? The answer is, on the whole, we've seen improvements in all of those things. And this is where the academic research can help us. What I'm dead confident in is, if you deploy this model from an employee perspective, you will see higher retention. People are less likely to quit, less absenteeism. People are more likely to show up, higher levels of measured employee engagement. That I'm confident in. Connecting that to profits and productivity is an open question. How much of that would have happened anyway without those things? And that's some of what I think we will be studying at the Center for Shared Ownership. Are companies owned by employees attractive targets for PE? Or do the complexities of negotiating a purchase of an ESOP and the ingrained employee-owned culture make the execution unattractive? The employee-owned culture is ideal. The other parts that you've mentioned here are the challenges. Negotiating a purchase from an ESOP, the trustee's fiduciary liability, a full employee vote, all of those things are some of the challenges. And then also, it's a weird thing to be cashing. When we buy a company, we really want the senior management team to keep their money in, or as much of it as possible. So if you take an ESOP, it's 100% employee owned, and you cash everybody out by buying it, it's kind of a weird incentive. You have a less employee owned business after the transaction. So that's another thing to think through in terms of buying an ESOP. But the cultural part is ideal. I mean, there's nothing better than an owner's mindset spread throughout an entire company.
Do you have any recommendations for all of us in terms of how can we work together, and how can we work more broadly to make sure that we're not being inadvertently dogmatic about our area of specialty?
It's funny you say this, because in my pitch deck to some of the foundations who are supporting this new nonprofit, that's definitely one of my complaints about the movement. I'm going to just see if I can even pull this up. Is I make exactly this point of, there's so many great people out there trying to do something around ownership, and there's really no one connecting the whole thing. So when you go out into the world, there's there are lenders, who are very interested in this. There are a number of academics. I could tell you at Harley-Davidson, the top shareholders are super supportive of this and want to see it spread. A company I'm a chairperson of, Ingersoll Rand, we have 16,000 employee owners as a public company. It's never been done before. It's amazing. I continue to be impressed by like how few people even know about what we're doing. We've distributed $400 million of wealth to low-income workers at that company. But no one really knows about it somehow. And so, but the research analyst community that has taken time to learn about it is very interested. There's other companies I'm working with right now and boards who want to find a way to share ownership broadly. If you talk to whether it's union leaders or individual employees, people have interest in this. I've spoken probably since the Wall Street Journal piece hit, to a half dozen senators who want to think more broadly about ownership. There's philanthropists out there like Ray Dalio who talk all the time about wealth inequality, and he talks about it as an engineering problem. We need to figure out how do we re-engineer the economy. My pitch to him is this is it. This is like the way that I'm in favor of trying to leverage the existing corporate infrastructure we've got and changing the way the spoils are split up as opposed to just totally dismantling capitalism. And so I think ownership can be a big part of that. People in the media, who are very supportive of this broader effort. So anyway, there's I think there's a lot to do here. And just to really bore you guys with my presentation, I won't take you through too many of these slides, but this is an example. If we could get the whole community of people with interest in employee ownership, let's just agree that before you roll ownership, you're going to share into the Center for Shared Ownership just a few metrics. Share with us employee engagement. Let's standardize on one measure. Let's use the Gallup Q12 as an example. Let's measure employee turnover, absenteeism, and employee safety, and maybe some detail on the equity plans. We'll, so if you follow me, I'm down here, with this data coming into the center. We'll run a bunch of experiments and we'll get some results. And then we will be working with, workers, lenders, academics, the government, the media, other shareholders, and we'll try and spread this as a movement. And we'll, along the way, experiment with a bunch of different things. There's lots of different ways to share ownership. Restricted stock options, vesting schedules. There's other investments that you should be making in the workforce to, make them feel cared for, show them that this is more about just sprinkling a little bit of economics their way. How you educate employees on the value creation plan, on the business plan, and then how you bring worker voice into the company. So we could be experimenting with all of these things, along the way. And if we're gonna pull together a movement, I do think we need some standards. One of the beauties of ESOPs is it's standardized. You can't fake an ESOP, really. I mean, there's an amount, you got to give all the ownership to the workers, right? There's no, you can have some hybrid equity, sure, with some warrants. I get that, but there's a limit to that. And if an ESOP works, employees are going to get wealthy. And I think if we're going to do stuff outside of an ESOP model where there is no standardization, I'm hoping this nonprofit can set the standard and say, well, how much equity and what form of equity is acceptable, and what else are you doing in terms of how you treat employees and how you bring worker voice into the business, et cetera. So it's not just ownership. And this would also protect against companies faking it, which could damage the movement. The worst thing would be a company just hands out a tiny amount of ownership. Yeah, sure, we're doing that worker ownership thing, and that would screw us all up. So that's another reason why setting standards would be so important. And then this nonprofit will be basically hopefully a PR machine. So you can imagine a podcast, email blasts, and social media campaigns. This film, I think, is going to be great, which we're going to talk a little bit about tomorrow in a Wall Street Journal article. And because at the end, this is going to be about inspiring people to act. It's a lot of the employee testimonials and the videos of employees finding out, what their ownership is worth, and all that stuff really moves people to wanting to do this at their companies. There's another goal of this nonprofit is there is a a governmental component to it. You know, I think from a disclosure standpoint, public companies could disclose a whole lot more about how low-income workers are treated. If you look at in Europe, the EU non-financial disclosure mandate gives you some insight into this. We don't have anything like this. I think we need it. I think a public company has to disclose safety metrics to OSHA anyway. Why are they not? Shouldn't it be in the 10K? I mean, why wouldn't an investor want to see that? Employee turnover, telling us more about the breadth and depth of equity plans. When I talk to public equity investors, they say, yeah, I'd love to see that. And shining a light on it would shine a light on the treatment of low-income workers in America, if there were more information about it. The ESOP legislation I mentioned, if I could write it all up, this is coming from someone who's never done an ESOP, so take this with a grain of salt, but I've studied them to death for 20 years. There were some things I would change if I could. I think I'd have more success in convincing people to try these conversions. And then tax incentives, tax rates are going up. Maybe they should go up differentially depending on how broadly or narrowly you share equity. I don't know if it's a good idea, but it's an idea and something to explore. And then this is I'll stop there, but this is our nonprofit and our funding plan and where we're trying to go with it.
That's great. So we have just about 5 minutes left. I love that presentation, by the way. So I think that was a good use of time. Thank you for sharing it with us.
Sure.
It was great. That was better than some of the questions we could have, at least the question I asked. Anyway, what other questions do you all have?
Pete,
So-
I'm involved with the
Go ahead.
financing ESOPs as a banker. So you mentioned the roadblock that I often hear is when the attorneys get involved, they throw up all the roadblocks. It doesn't sound like you've had great success in convincing them either, but have you found any magic bullets when you're talking to attorneys that change their mind? Anything in your presentation?
No, and the other challenge that I didn't mention was when you get up to a company of a certain scale, they typically have global operations. So, then you also get into, oh, well, God, I could do something for my US employees, but what am I going to do for the rest of my employees? I don't want to have like a US ESOP. And then, so that I have not found a magic bullet. It's been tricky.
Okay. I'm glad I'm not alone.
Yeah.
When you look at us from a commission, I gave you a high level understanding of where we sit in this role. What do you think we could do to support this work? Do you have ideas, advice for us as a commission?
What we're all trying to do is almost like pull off a cultural change in corporate America, which is such a daunting task. But I actually think this is going to work, which is probably insane. But I feel like if enough of us do this, and we all work hard at it and share some of the good stories. And by the way, the best advocates are the leaders of the companies who have done this. I mean, what we hear oftentimes is that's the most meaningful thing I have ever done in my life, is to lead my low-income colleagues towards a path of dignified retirement or wealth creation for the first time, buying a home or getting out of debt, or that's way more meaningful than the money that I made myself. So, I think just trying to push on all angles, and we just need more people taking leadership roles. And like I said, I'm probably just foolish enough to think this is actually going to work and that we're going to make progress, but that's what I think.
Really quick one. It's just because you've mentioned about the performance that usually selling this idea to entrepreneurs and other investors, that you don't go through the path of performance, but focus on this is the right thing to do. But do you think through the research and bringing empirical data on how those businesses actually improve their performance, that would be easier to sell the idea?
Yeah, I do think it would help. I mean, the things that we've never quantified, as an example, like what's the cost of employee turnover? What's the cost of all the rehiring and the poor quality and productivity from having less experienced employees? What's the cost of low levels of employee engagement? By the way, for a private equity firm, on exit, when you sell a company, what's it worth for people to say, holy cow, you have a manufacturing company where your employee turnover is 2%, and your employee engagement scores are 70%. If you take Ingersoll Rand, when we took that company private, it was a public company known as Gardner Denver at the time. Our employee engagement scores were in the 17th percentile, 17, and they're now in the 70th. and we've got 16,000 people who have meaningful amounts of ownership. Like that's just got to be more valuable. So I think not only the cost of disengaged employees with high turnover, but the value of a stronger culture. I'm a firm believer this all pays for itself. So yes, I think it will help. But I also am trying to get out of the mode of, well, we should only do if it's good for shareholders. Because if it's not good for shareholders, then like forget it. I feel like this, as a society and as corporate America, we're trying to get out of that a little bit and more towards, let's build stronger companies across all the various dimensions and it'll take care of itself. Otherwise, we're back in Milton Friedman, 1974, where it's all about the shareholder. And then we're going to destroy the economy and destroy capitalism.
Yes, I absolutely. It's just because I also think that this is an argument that is a two-way street, because you only increase your performance because it's good for your workers. Because if it's not, you're not gonna get that performance increase. So I think this is where my mind's at, but I absolutely understand.
Yeah.
Thank you.
Yeah, my pleasure. Again, thank you for having me.
Well, thank you for spending your time with us. I just really appreciate it. And please stay connected with us. If you find a Colorado company, let us know, because we want to help them. So, please stay in touch with us, and we'll look forward to seeing all the great work that you're going to do.
Okay, will do. Thanks for having me. I post updates on LinkedIn. We have on my LinkedIn site, I'm always posting stuff. So we'll post this article that's coming out in the journal in the next couple of days. And then, we'll keep plugging along on our side. Thanks for everything you guys are doing. And thanks for having me.